At Doodle Diligence, we break down public companies and global market events using nothing but the facts. Hiya, I'm Sophia. This is Fido. Today at Doodle Diligence, we're investigating a multi-trillion-dollar crime scene. On January 30th, $7 trillion in market value vanished in a single day. The question I am asking, who stole the gold? Before this great sell-off, 2025 was a standout year. Gold had surged nearly 96% over the previous 12 months, hitting a record high of $5,595 an ounce on January 29th. But, in a matter of just a few hours, on January 30th, the elevator cable snapped. Gold plunged 9%, crashing to around $4,895. This wasn't just a bad day, it was the steepest single-day decline for the metal since the early 1980s. Silver's fall was even more violent. Within the same window, it plummeted as much as 35% intraday, its largest one-day drop in history, falling from an opening of $115 to close at $85. In just 24 hours, the two metals saw $7 trillion in market value vanish. How did Bitcoin react to the falling of gold? While gold and silver were in freefall, all eyes turned to the so-called digital gold Bitcoin. Bitcoin had an incredible run in late 2025, peaking at $126,210 in October and starting January 2026 strong near $100,000. But cracks appeared early. By late January, Bitcoin began sliding as institutional flows turned. On the 29th of January 2026, as precious metals buckled, Bitcoin followed. In just 24 hours, it crashed 15%, plummeting from $96,000 to $80,000. The decline didn't stop there. The digital gold narrative faced a brutal reality check. By February 5th, Bitcoin sank to $63,000, wiping out half its value from that October peak in just a few months. This wasn't just a dip, it was a liquidity event. In a single 24-hour window during the height of the panic, over $1 billion in Bitcoin positions were forcibly liquidated. Instead of acting as a hedge against the chaos in gold and silver, Bitcoin traded like a leveraged bet on the very market stress people were trying to avoid. Safe haven or risk hedge? So, if gold is the ultimate insurance and Bitcoin is supposed to be digital gold, why did they both collapse as risk-off sentiment sharpened so significantly in such a short time? A few key triggers hit at once. The Fed shift. On the 30th of January 2026, President Trump, the world's biggest fan of interest rate cuts, surprised everyone by nominating Kevin Warsh to succeed Jerome Powell as the next Fed chair. Given Warsh's legendary reputation as a hawk who eats inflation for breakfast, the nomination hit the market like a bucket of ice water. It wasn't just a transition, it was a total Warsh shock. The crowded trade. Both assets were over-positioned, meaning too many investors had made the same bet at the same time. It was like everyone was standing on the same side of a boat. When the first big players started taking profits quickly, followed by the retail investors who were the last ones to climb aboard, the weight became too much. The boat hasn't flipped yet, but it's dangerously close to tipping over. The AI narrative shift. Investors began reassessing the AI trade. Concerns that AI might disrupt legacy software models led to a rotation out of risk-on assets, dragging Bitcoin, which currently correlates more with high beta tech than physical gold, down with it. Why do ETFs matter? To understand this massive scale sell-off, we have to look at the ETFs. Gold ETFs have been around since November 2004, the famous GLD. providing easy access for institutions for over 2 decades. Spot Bitcoin ETFs only joined the party in January 2024, but they quickly became some of the most successful launches in financial history. Why does this matter? ETFs turned retail-favored assets into institutional staples. But here's the catch. Institutions often have a lower risk tolerance than the diamond-handed retail investor. This wasn't just mom-and-pop selling. It was driven by volatility control strategies and margin calls from large institutional trading desks. Because these desks often group Bitcoin and gold into the same risk portfolios, a spike in volatility triggers automated mechanical selling. When the machines see red, they don't care about the safe haven or digital gold narrative, they just hit the exit. What are the predictions for gold and Bitcoin in 2026? With the market still reeling, everyone wants to know, is this the end of the bull run or just a temporary detour? We're essentially asking our thief suspects for their alibi. Let's look at the big banks. Despite the gold recent crash to $4,895, the institutional consensus for the rest of 2026 remains surprisingly bullish. JP Morgan just aggressively raised its year-end 2026 gold target to $6,300 an ounce. Their analysts believe central banks will step in as structural dip buyers, providing a rock-solid floor by the fourth quarter. Goldman Sachs isn't far behind, bumping their target to $5,400 as private investors treat gold as long-term insurance against AI-driven policy risks. Now, what about Bitcoin? The timing there is a bit more divided, but two giants have just converged on a single number. Bernstein and Standard Chartered both predict that while we might see a short-term retest of the $60,000 support level, the market will officially reverse in the first half of 2026. Both firms are now targeting $150,000 by the end of the year. Bernstein is particularly bold, calling this current downturn the weakest bear case scenario in history. They argue that because there are no structural failures or toxic leverage like in past crashes, this is just a temporary confidence shock before the climb resumes. Meanwhile, Jeffrey Kendrick at Standard Chartered recently slashed his previous $300,000 target in half to meet Bernstein at that $150,000 mark. He points out that the aggressive corporate treasury buying that fueled the last rally has cooled off. For the rest of 2026, he believes future gains will rely almost entirely on periodical ETF inflows rather than a constant wave of new institutional money. However, not everyone is buying the recovery story. On the more pessimistic side, John Blank at Zacks Investment Research warns that the technical damage could be long-lasting. He believes Bitcoin could fall as low as $40,000 within the year if liquidity continues to tighten. Other bears point to the AI bubble as the ultimate catalyst. If big tech spending pulls back mid-year, the resulting risk-off environment could leave Bitcoin struggling to find a floor above $50,000, effectively ending the current cycle prematurely. 2026 is proving to be a complex year, defined by geopolitical tension, the breakneck speed of AI, and massive monetary policy uncertainty. But let's be honest, has any year in the markets ever been ordinary? So, is this the end of the safe haven narrative, or just a healthy flush of the speculators? Was the value of gold and Bitcoin truly stolen by institutional hands, or did they simply fall victim to their own dizzying heights? The case is in your hands now. Is the thief still at large, or is the market simply resetting for a new peak? The verdict is yours. Drop your thoughts below. Want to stay ahead of the next market mystery? Subscribe to Doodle Diligence. See ya!